Hello, good people, and welcome back to G World Markets Academy. We continue with our discussion on the basic Forex terminologies. During our previous module, we discussed about the lot size. And I believe by now you've gone through the module and you clearly understand what the lot size is all about. Today, we're going to talk about leverage, another very important Forex terminology. We're going to look at what it is and what a trader needs to know whenever they are using leverage. So what is leverage? This is basically a loan from the broker. It will enable a trader to take positions of higher value than their account size or than the amount of capital they have injected into their trading account. And just to expound on this, assume you're trying to buy shares with X amount of cash and each share costs, say, Y shillings per share. You can only be able to buy shares equivalent to the amount of capital divided by the cost per share. That is X divided by Y. But with leverage, you'll be able to buy more shares because you have a multiplier effect. The leverage, which you're saying it will increase the amount of capital you have. And once you divide that by Y, this clearly shows you can buy more shares or take larger positions than a case whereby you don't have leverage. So that's the multiplier effect brought about by leverage. This leverage is represented as a ratio between the amount of capital you have and the maximum loan or leverage you can get from the broker. Some brokers could offer as high as 800 times the amount of capital you put in, or even higher. But it is advisable when you opening your account, you make use of say 100 or 200 as the leverage. So you'll have an opportunity to select how much loan I would want or what is the multiplier effect I would want to get from the broker. So you can choose 800, 1000 or even higher, but for a start, it's highly advisable you pick either 100 or 200 as the leverage. We shall discuss further why this is the case. But when you start your trading, it's highly recommended that you work with anything between 5 to 10 or even less. Because as much as this leverage is a good thing, as much as it will have a multiplier effect, it will also have a negative effect into your account whenever the odds are against you. So we're saying it is a double-edged sword, but you need to work out your risk management properly for you to be able to benefit from the leverage. It does not mean if you pick higher leverage, you will not benefit from it. Yes, you will benefit from it, but the reverse is also true when odds are against you. The factor by which you gain, it is also the same factor by which you lose if you don't manage leverage properly. Let's look at an example whereby somebody has an account of $5,000 and they select different leverages as offered by their broker. So you could have a case whereby you're saying, I want a multiplier of 50 or a multiplier of 40 or maybe 5. If you pick a 50, it means you're multiplying the amount of money you have 50 times, giving you 250,000 as the maximum lot size, which is equivalent to 2.5 lots. Remember we said earlier that a lot is equal to 100,000 units. And this gives a pip value of 25 units. So the larger the lot size, the higher the value of the pip. And as much as it may mean the higher the value of the gain you will have per pip, it also means the higher the value of the loss you will have per pip. And this is the reason you have had people blowing their accounts within days or within hours, because somebody picks a leverage value which is too high And if it's too high, the gains might be too high, but when the losses are too high, that's the point whereby you clearly or eventually lose your money. So be very careful when you're using leverage or when you're choosing the leverage to work with. And for this example here, if you choose to work with 25 as the value of your pip, for you to lose the account, you need about 200 pips. But if you work with 2.5 as a pip value, meaning you have chose 5 to 1 as the leverage to work with, you need about 2000 pips for you to be able to lose your account. So the gains might be small here, but you need to build your account slow but sure, and eventually you will have a strong account. But easy come, easy go. Faster results by gaining, it also means faster results by losing. So be very careful when working the leverage. But don't bother so much about what it is and how to navigate about. Once you start working with the numbers, you'll be able to understand what this is all about. So in summary, we have talked about leverage being a loan from the broker. It allows you to take positions of higher value than the account size. But we have said it's a double-edged sword. Be very careful when you're working with it. To open an account, you can choose either 100 or 200 as a leverage. But if you want to make use of the leverage, anything between 5 to 10 is okay, or even less. But work out on your risk management for you to be able to benefit from leverage. That brings us to the end of our discussion today. During our next module, we shall discuss about margin requirement, and margin level. These are other very important terminologies which will help you now during your trading process. Kindly leave us a comment, subscribe, and hit the notification button so that you'll be notified once we upload our next video. Thank you and bye bye for now.